Long ago, people used to trade things directly from what they needed, like a potter giving clay pots for fresh fruits. But as communities grew, they needed something easier for trade, so they started using shiny metal coins with special designs on them. These coins made trading much simpler and everyone liked them. Then, as time passed, people realized carrying heavy coins was tough, so they invented paper money, which was like a promise to give you real metal if you wanted it. People loved the convenience of paper money and it became popular worldwide. But the story didn't end here. With modern technology, money went digital. You could now buy things without using any physical coins or notes. Instead, you could use debit cards, credit cards, and even phone apps to pay for stuff. It was like magic. Today, there is something new called cryptocurrencies. These are digital currencies which might change the future of money. Throughout history, money has changed a lot, from bartering to metal coins, then paper money, and now digital currencies. It's fascinating to see how money has evolved and how it affects our lives and the world around us. Let's explore in this chapter the wonders of money together and learn about the importance in our everyday life. Hey everyone, welcome to JAIIB on Tips. Let's start learning chapter number 14 of Indian economy, that is money supply and inflation. Let's understand the functions of money. There are different functions of money, that is medium of exchange, a measure of value, a store of value over time, and a standard for deferred payments. Let's understand it one by one. Medium of exchange says money is like a special tool that helps us trade things we want, right? Instead of directly swapping goods or services, we use money to buy and sell stuff. It's like having a universal language for trading. What is a measure of value? Imagine money as a ruler that helps us measure how much things are worth. When we buy something, we can see its price in terms of money, making it easy to understand its value. Okay. Then there is a store of value over time. Money is like a little safe where we can keep our extra stuff for the future. We save money today and later on, we can use it to pay for things we need or want, right? Last one is a standard for deferred payments. Money also helps us plan for the future. When we make agreements or contracts, we use money as a promise for future payments. It's like setting a fixed rule for what we will get or give later. Let's understand deferred payments. Deferred payments simply means that you can buy something now and pay for it later. That means buy now, pay later. Right? Instead of paying the full amount right away, you agree to make one or more payments in the future according to the terms of the agreement. It's like when you want to buy a new phone but don't have all the money right now, the store offers you the option to pay for the phone over several months. So you get the phone now and promise to pay a certain amount each month until the total cost is covered. Deferred payment can also be used when you borrow money, like taking a loan for a car or a house. Instead of paying for the car or a house all at once, you pay back the money you borrowed in smaller installments over time, right? It's a way to make big purchases more affordable by spreading the cost over a period, making it easier for you to manage your finances. However, keep in mind that there might be some extra charges or interest involved. So money has 4 amazing parts. It helps us trade things, measures the value of stuff, lets us save for later, and acts as a promise for what we will get in the future. Let's understand measures of money supply. First one is M0, which is also known as reserve money. This is like the magic word of the country's central bank, the Reserve Bank of India. M0 includes all the physical cash in circulations, coins and notes, plus the money that commercial banks keep in their accounts with the RBI. Second one is narrow money. Think of M1 as the money you can easily use for everyday transactions. It includes the coins and notes you carry in your wallet and the money you have in your regular bank account that you can withdraw anytime. So M1 is like your quick access money, right? Next is M2. So let's expand M1 and add something else, that is savings. M2 includes everything in M1, but it also counts the money you have saved in a post office saving accounts. So M2 is your quick access money plus the money you are saving for the future. Right. Now what is M3? M3 is a broad money. Building on M2, we bring in some time deposit. These are like magical treasure chest where you put your money for a specific period and it grows with interest. So M3 includes everything in M2 and adds the money you have set aside in time deposits. It's quick access money, savings, and some money you are growing over time. Right. Last one is M4. M4 includes everything in M3 and it also counts all the money you have saved in post office savings account except National Savings Certificate. So M4 is like a grand total of all the money you have in all the saving accounts including post office funds. So in a nutshell, we can say that M0 is a currency in circulation plus bankers deposit with the RBI and others deposit with the RBI. M1 is the currency with the public plus demand deposit with the banking system plus other deposit with the RBI. M2 is M1 plus saving deposits of post office savings banks. M3 is M1 plus time deposit with the banking system. M4 is M3 plus all deposit with post office savings banks excluding NSC. Right. Understanding these measures helps us see how much money is available in the economy for spending, saving and growing, which is essential for keeping our financial system running smoothly. Now the next topic is money multiplier. Money multiplier is a concept introduced by Milton Friedman and Anna Schwartz in 1963. Right. So it is the process that explains through which the base money created by a central bank multiplies in the banking system to the stock of broad money at any point of time. Let's simplify this, that it explains how the money created by a central bank, that is the base money, M0, can multiply in the banking system to become the total money supply, that is the broad money in the economy, which is M3. Right. There are three important factors that determine the money multiplier. First is currency to deposit ratio. Sees how much cash people prefer to hold compared to keeping it in the bank. Second is required reserves to total deposits. It is the percentage of deposit that bank must keep as reserves set by the central bank. And the third is excess reserve held by banks. It is the extra reserve banks choose to keep with the central bank beyond the required amount. Right. So the money multiplier is calculated as broad money that is M3 divided by base money which is M0. Right? Let's imagine you put some money, let's say rupees 100 in a bank account. The bank keeps a small portion of this money. Just say that bank keep rupees 10 as a deposit money and the bank takes that money 90 rupees and lends it to someone who wants to borrow money, like for a home loan or for a business loan. The borrower takes that rupees 90 and spends it on something like buying a new computer. The person who sold the computer then takes that rupees 90 and deposits it to bank. Right. Now this money again went to the bank. Right. The bank once again keeps a small safety reserve, that is the 10% of 90, which is rupees 9, and lends the remaining rupees 81 to someone else. Right. This cycle continues, and with each round the bank keeps a fraction as a safety reserve and lends out the rest. Every time someone borrows and spends, the money comes back to the bank, and it keeps repeating the process. And here's the magic part. The initial rupees 100, this rupees 100 you deposited in the bank starts to create a chain reaction. It gets lent out, spent, deposited and lent out again and again. Each time it goes through this cycle, more and more money is created. So the money you initially deposited becomes much more than just rupees 100. It multiplies and grows into a larger amount as it keeps circulating in the economy. That's the money multiplier in action. A magical process where a small amount of money turns into a bigger pool of money through the power of lending and spending. The next one is velocity of money. The velocity of money is the frequency with which one unit of currency is used on domestically produced goods and services in a specific time period. In other words, it is the number of times of money is spent to purchase goods and services in a unit of time. Let's understand this. Velocity of money is like a speedometer that tells us how fast money is moving through the economy. It measures how many times one unit of currency like rupees 1 is used to buy goods and services in a given time, say a year. Let's understand this with an example. Imagine you have rupees 1 and now you use it to buy a candy from a shop. The shopkeeper takes that rupees 1 and uses it to buy some fruits from a vendor. The vendor in turn uses that same rupees 1 to buy a pencil from a student. In this example, that rupees 1 was used 3 times to buy different things. So the velocity of money here is 3. Correct? Now, this concept is linked to the overall size of the economy. To understand this link, we look at the total value of all goods and services produced in the economy, which is called nominal GDP. We then compare this with the total money available in the economy, known as broad economy. Right? So, the velocity of money is simply the ratio of nominal GDP to broad money. It is the ratio of nominal GDP upon broad money. Right? It helps economists and policymakers understand how quickly money is being spent to buy goods and services. So in summary, velocity of money tells us how fast money is circulating in the economy, and it is found by comparing the total value of goods and services to the total money supply. It's an essential measure to understand the speed and impact of money on the economy. So we have learned 2 topics, that is money multiplier and velocity of money, where money multiplier is the link between broad money and reserve money, whereas velocity is the link between broad money and nominal GDP. While money multiplier is calculated as broad money upon reserve money, whereas velocity is calculated as nominal GDP upon broad money. So the next topic is inflation. The concept of inflation refers to a sustained rise in the general level of prices of goods and services in an economy over a period of time. Inflation is like a continuous hike in the prices of things we buy. It happens when over time the cost of goods and services keeps going up. Imagine you used to buy a chocolate bar for rupees 10. But now it costs rupees 15, and the same goes for other items like fruits, clothes, and even services like transportation. When the prices of many things increase together, it's called inflation. So inflation means that as time goes by, you need more money to buy the same things you used to buy for less. It's like money's value is slowly going down and things become more expensive. Inflation is an essential concept for understanding how the cost of living changes and how the purchasing power of money can be affected over time. It's something that economists and policymakers keep an eye on to ensure a stable and balanced economy. So inflation rate is the measure that tells us how fast prices are rising. It's like checking the speed of the price increase. And inflation has both positive and negative effects on an economy. What are the positive effects? Positive effects of inflation include helping the economy during recessions by boosting spending and making debts easier to pay off because their real value decreases. And what are the negative effects? Negative effects of inflation include the loss of purchasing power as your money buys less, uncertainty about the future making people hesitant to save or invest, and sometimes shortages of goods because people hoard them to avoid higher prices in the future. There are different causes of inflation. The first one is cost push inflation. It is a type of inflation caused by substantial increases in the cost of production of important goods or services where no suitable alternative is available. Which means, imagine the cost of making things goes up, like when the price of oil goes up. Since oil is used to produce many things, the cost of making those things also increases, right? The producers then raise the prices of their products to cover the higher cost, which means we as consumers have to pay more for those goods, right? Second one is demand pull inflation. It is a rise in general prices caused by increasing aggregate demand for goods and services. It happens when lots of people have money to spend and they all want to buy more things. When everyone rushes to buy the same goods and services, the demand becomes higher than what's available in the market. As a result, the prices of those goods and services go up because everyone wants to get their hands on them. So in both the cases, the result is that the prices of many things we buy go up and our money doesn't go as far as it used to. So things become more expensive and we may not be able to buy as much with the same amount of money. So inflation is an important concept to understand because it affects our daily lives and how much we can afford to buy. Economists and policymakers work to control inflation and keep it at a level that is good for the economy and for all of us. Let's understand some of the important indices. First one is Consumer Price Index. Consumer Price Index reflects the change in the level of prices of a basket of goods and services purchased or consumed by the household. It measures the prices at the retail level. Simply, it is like a shopping list that tells us how much the prices of these things we buy change over time. It looks at the cost of a basket of goods and services that households typically purchase. Imagine the basket includes things like food, clothes, transportation and other daily essentials. The CPI measures how much these prices go up or down each month, showing us if the cost of living is increasing or decreasing. The CPI is important for us, the consumers, because it helps us understand how much more or less we need to spend on our everyday items. Core inflation is a way of looking at inflation by removing the effects of food and energy prices, which can be more volatile. It helps us see the underlying trend in inflation without the influence of these unstable factors. The NSO, National Statistical Office, NSO, releases the CPI and the Consumer Food Price Index, CFPI, regularly, right? So NSO releases the CPI and CFPI regularly. The CFPI focuses especially on food prices because they are a significant part of our expenses. The RBI uses the CPI information to make decisions about the country's money and interest rates. It helps them keep an eye on how the cost of living affects us and our economy. So the CPI is like a shopping guide for the prices of things we buy, and it's crucial for understanding inflation and how it impacts our wallets and the economy as a whole. There are three different index numbers of consumer prices. These are CPI for industrial workers, CPI for agricultural laborers or rural laborers, CPI rural, CPI urban and CPI combined. Second one is Wholesale Price Index. The WPI reflects the change in the level of prices of a basket of goods at the wholesale level. WPI focuses on the price of goods traded between corporations at the wholesale stage rather than goods bought by consumers. WPI is like a big list that shows how the prices of goods change at the wholesale level. It focuses on the prices of things that companies trade with each other before reaching the consumers. WPI helps us see how prices are changing for industries and manufacturing. The WPI base year is 2011 and 12. Base year of WPI is 2011-12, right? And represent the following three commodity groups. First one is primary articles, right, like raw materials. Second is fuel and power, like electricity and fuel. Third one is manufactured products, like finished goods. GDP deflator. GDP deflator is a measure of the level of prices of all new domestically produced final goods and services in an economy. The GDP deflator, also called implicit price deflator, and it is a measure of inflation. GDP deflator is like a measure of inflation that shows how prices of all goods and services in the country change. It's different from WPI and other indices because it covers everything that is produced in the economy, not just a specific basket of goods. It's like a more comprehensive way of measuring inflation. GDP deflator helps us understand how much of the increase in GDP is due to higher prices rather than an increase in the actual production of goods and services. So GDP price deflator is calculated as GDP price deflator is calculated as nominal GDP upon real GDP into 100. Please remember this formula because it is asked in exam to calculate the GDP price deflator, right? So GDP deflator is available only on a quarterly basis along with GDP estimates, whereas the CPI and WPI data are released every month, right? Last one is Index of Industrial Production, that is IIP. It is also released by NSO of MOSPI every month. It is a measure of industrial activities. There are three groups, namely mining, manufacturing and electricity, with maximum weightage to manufacturing. The base year is 2011-12. So it is like a report card that tells us how well the industries in the country are doing. It measures the level of industrial activities including mining, manufacturing and electricity, but the maximum weightage is for manufacturing, right? I hope this chapter is clear to you all. Now, after studying from this video, just go through the notes and the quizzes provided in the Telegram group of JAIIB on tips. So, see you all that side. Complete the notes, complete the quizzes. That's it for this chapter. You are done with the chapter 14 of Indian economy.